Chapter 10 covers payroll computations, payroll records, and how to record payroll payments. So first you might want to ask yourself, are you an employee? Well, if you are an employee, there are certain characteristics that must be met. First, you are under the direction and control of the employer. The employer provides the tool or equipment you need to complete your job, and you're working certain hours that are set by the employer. Now, you may have some flexibility for whether you work first shift, second shift, things of that nature, but for the most part, the employer is going to determine the hours worked by the employees. Some example employees are the company's president, the bookkeeper, sales clerk, warehouse worker. These are all employees of a business organization. Now, because you are an employee, there are certain type of deductions that are mandated by federal, state, and local law to be withheld from your earnings. Let's first discuss an act that was passed way back in 1938, known as the Fair Labor Standards Act. This act is also called the Wage and Hour Law, and there are two important concepts that are still in existence today because of this act. First, there's a minimum hourly rate of pay and maximum hours of work, and this says per week. I'm going to say per pay period to be performed at the regular rate of pay. So what does that mean? It means that every state has a minimum hourly rate of pay. So if you work in Missouri or in Illinois, you can look up to see what is the minimum hourly rate of pay. That is the lowest amount you can earn per hour when working as an employee in the state of Missouri or the state of Illinois. Then, if you work more than the maximum hours, and again, I would say per pay period, because some may be paid every 2 weeks, perhaps you're paid bi-monthly, perhaps you're paid once a month, but if you work more than the maximum hour within a given pay period, then because of this act, you're required by law to receive what's known as overtime compensation. And your overtime rate of pay is 1.5 times your regular rate of pay. So we're going to use a weekly pay period in our illustration. So for our examples, if a person works more than 40 hours within a week, then he or she is entitled to receive overtime compensation. And again, the overtime rate is going to be 1.5 times that employee's regular rate of pay. Now, there are different ways to determine an employee's gross wages or their gross salary. Wages, salary. We'll discuss this in a minute, the difference between earning wages and the difference between earning an actual salary. Okay? Hourly rate basis. When you're paid an hourly rate basis, that means you're earning wages. You're paid a set amount per hour. So maybe you're earning $10 per hour. That means you're earning wages. Other time you pay on a salary basis, meaning you're paid a set amount per pay period. So perhaps you're paid monthly and you're paid $5,000 per month as your salary. When you're paid on a salary basis, it is not contingent upon the number of hours that you work within that pay period. When you're paid on a salary basis, you are paid a set amount of money per pay period. Hourly rate means you're paid a set amount of money per hour that you work. So again, when you pay hourly, that's known as earning wages. when you're paid a set amount per pay period, you're earning what's known as a salary. Commission basis focus on those who work in sales for the most part. So when you're working on a commission basis, typically you receive a percentage of your sales or your net sales for that pay period in a form of compensation. So if you're working in retail, there could be a combination of an hourly rate basis and a commission basis where you're paid maybe $10 per hour, but maybe you're also paid 2% commission on all the sales that you had within that time period. Now, the piece rate basis may not be as familiar. This is a rate of pay or compensation computation. No, compensation, say it right the first time. That is contingent upon productivity. So we're saying here is that they're going to pay you a set amount based upon how productive you were for that pay period. So this is huge or very common in the textile industry, the farm industry, where again, they're going to pay you a set amount based upon your productivity. So perhaps if you're making a product, they may pay you $1 per unit you produce. So depending on how many units you produce, that's going to dictate how much money you're going to get paid. So the harder you work, the more money you're going to make with the piece rate basis. So to come to determine the actual gross wage or salary for each employee, they'll be paid one of these four different ways, or it could be a combination of these. Okay? So to compute the actual gross pay amount, go back. You take the regular hours worked, those will be 40 hours or less, times the regular rate of pay to get the employee's gross pay. So Alicia, 40 hours times $10 an hour. Rodriguez, 40 hours at $9.50 an hour, and it's showing you their gross pay amount. Now, if an employee has worked overtime like George has, George is earning $9 per hour, but he worked 45 hours within this pay period, which means he has 40 hours at regular pay and 5 hours at his overtime rate. Now, his overtime rate of pay is 1.5 times his regular rate of pay. So if you take 9 times 1.5, that'll give you $13.50 as George's overtime rate of pay. So any hours worked over 40 is multiplied times the overtime rate of pay. So total earnings for George would be $427.50. So again, if there's overtime, you must determine how many hours of overtime will work. Their overtime rate will be 1.5 times their regular rate of pay. So take the regular rate times 1.5 to get their overtime rate of pay. Okay? Now, there are certain deductions that are withheld from your gross pay to get to your net pay amount. There was another act passed in 1935 called the Federal Insurance Contribution Act. Now, there are two types of taxes that are imposed on both the employee and the employer because of that act. Those are the Social Security tax and the Medicare tax. So these taxes are paid by both the employee and they're also paid by the employer. Let's first talk about Social Security tax. The Social Security tax rate is 6.2%. That says as of 2016, your textbook is old, but this is the same rate in 2019, is 6.2%. Social Security is a tax that is imposed on the employer and the employee This tax provides you with certain benefits upon reaching the age of retirement or if one was to become disabled. So you're paying Social Security tax now so that once you reach the age of retirement, you can receive what's known as Social Security benefits. Or if you become disabled, you can also receive the Social Security benefits. Now, if a person becomes deceased and they have a surviving spouse, that spouse may receive their benefits, or if they have dependent children, typically under the age of 18, they may also receive the benefits from that recipient. So when it comes to paying the Social Security tax, it's a tax of 6.2% on your earnings each year up to a calendar year earnings base. So what does that mean? It means that if your income exceeds a certain dollar amount per year, the amount over the earnings base is going to be non-taxable, or what we call tax exempt. So for example, in 2016, if a person earned more than 122,700 in that tax year, then the amount over this dollar amount would be non-taxable, what we call tax exempt. For example, if an employee earned in 2016 142,700, the first 122,700 would be taxable, but the other 20,000 that's over this earning base would be non-taxable, or what's known as tax exempt. So we hear the term tax exempt wages. This means that if your earnings or exceed what's known as the maximum earnings base, and this amount changes every year. It was this amount in 2016. It's up to 128,700 as in 2019. But again, if the employee earnings exceeds the maximum earnings base, the excess of the base amount is not subject to Social Security withholding, meaning we call that amount non-taxable or tax exempt. Now, perhaps you work more than one job and each employer is taking out Social Security taxes. Well, they'll take out those taxes on your earnings up to the maximum earnings base for each employee. So let's say if you earn 100,000 at one job and you earn 75,000 at a different job, they're both going to tax you on your total earnings because you didn't earn the earning base separately at either job. But the good news is if you were taxed on your total earnings more than the earnings base, then you're going to get a refund when you file your taxes on the excess amount. So that means if you're working for more than one employer and they're both taking out what we call Social Security taxes, if your total earnings is over the maximum earnings base, then you're going to get a refund for the additional Social Security tax withheld from your earnings. Okay? We're going to come back with some calculations on Social Security tax and then discuss how to determine deductions for the Medicare tax.